So in effect, it's fairly priced, and I'm getting the upside in the silver price and any exploration upside for free. It's also true that if I get any exploration upside, that it's not unlikely that an acquirer will buy the company if the share price doesn't go up.
In today's video, get ready for an insightful interview with renowned commodities guru expert Rick Rule. Join us as he shares his perspective on the upcoming BRICS meeting, the performance of silver and gold, and his expectations for the August 22nd event. Plus, Rick delves into the recent developments with Silvercrest. Stay tuned for expert insights into the world of finance and commodities. Watch until the end and post your thoughts in the comments section below. Thanks for joining us. Now let's get back to Rick Rule.
Well, it depends on how much gold they bought. If they increase the number of US dollars in circulation and reduce the amount of gold in circulation, the gold price in US dollars would rise. It's an open question as to what would happen to the US dollar price relative to other currencies. Understand that the free float of gold relative to the free float of currency on a global basis is infinitesimal. It doesn't matter. I listened to Jim's presentation with interest, as I always do, because of Jim's background, being general counsel at Long-Term Capital Management, as an example. Having an insider's view in a circumstance that almost brought down capital markets worldwide gives him a unique perspective on catastrophic events. My view to the BRICS currency is different than his. I agree with him that if it comes to existence, it will not be a currency. It will not be something that you or I or Chinese citizens or Russian citizens own. It will be, in fact, a settlement mechanism. But for a settlement mechanism to exist, you have to perfect settlement. That means that all of the countries that are signatories to the BRICS agreement, in order to participate in the BRICS settlement system, would need to contribute sufficient gold to the bank that they could effect settlement. Otherwise, can you imagine, as an example, the Chinese running a large trade surplus with Russia and going to Putin, who still has his gold, and saying, we'd like our gold, please. And Putin say, well, here's some bricks. Not gold bricks, but rather bricks. The problem with that is that the 45 countries that have applied to the BRICS for admission mostly have no gold, which means if it occurred, it would largely be a surrogate bank controlled by the Saudis, the Iranians, and the Chinese. My suspicion is that the other 42 applicants to the BRICS system, while they don't trust us more than they trust each other. If I'm wrong, if in fact there is a settlement mechanism, a credible settlement mechanism that arises outside the US dollar, and if sufficient cooperation exists that countries are willing to subsume their own gold reserves to the settlement system, that would be a truly interesting state of affairs. The GDP of the applicants to the BRICS system is larger than the GDP of the G7. And so the potential exists for a settlement mechanism outside the US dollar that, if it occurred, would weaken the US dollar dramatically. Notice that I said if, Steve. My suspicion is that this won't occur in my lifetime. And for the record, I'm 70. Like their income and their savings relative to their expenditures, the number of dependents they have, how much risk they could take. I'm not ducking the question, by the way. People look for one size fits all answer when there's hundreds of millions of sizes out there. So it's very difficult to do. I would believe for most investors with $1 million net worth that they have the ability, and they should have the desire, to maintain substantial equity. It's only rich people that can maintain liquidity, because liquidity costs you. If you have a bank deposit or you hold gold, it doesn't pay you rent in excess of the depreciation of your purchasing power through inflation. So you have to have wealth to have liquidity. I say you have to have liquidity because in the 49 years I've been investing, once every 10 or 15 years, you have a liquidity squeeze, an event like 2008, which causes the price of everything to fall by half. And if you have cash in a circumstance like that, you take advantage of the circumstance rather than being taken advantage of by the circumstance. So I would ask right now that your listeners, as you describe them, have between 10 and 15% of their portfolio liquid. Liquid can include gold if you're actually willing to sell it, if a more attractive asset comes by you. And the rest of the liquidity needs to be in very short-term, short-denominated obligations. I start with liquidity. It's difficult for me to understand why anybody who is fairly young, and I would describe at age 70, the audience you describe as fairly young, wouldn't have 5% of their assets in physical precious metals. Certainly physical precious metals that were things like the Sprott Physical Gold Trust is okay. But physical precious metals, I regard that myself as volatile, but good liquidity. I see the circumstance in front of us as one where the purchasing power of fiat alternatives is declining, and knowledge of the fact that the purchasing power of fiat alternatives is declining, and when one where the increase in the price of gold relative to fiat alternatives is a very attractive. No guarantee, and I can't tell you in what period of time, but Steve, I would love it if when I died, the price of my gold hadn't increased. That means the price of all my other stuff did okay, and that would be a fair trade for me. I think that your investors, particularly of this age group, need to understand the demographics of natural resources, which is to say, we have underinvested in productive capacity around natural resources for 30 or 40 years. There are 8 billion of us on the planet, and we've done a great job over 40 years raising the living standards of the poorest of the poor, and we're going to continue to do that, which means that more and more people will be able to compete for access to material with you and I. In a world where we haven't invested enough to maintain current levels of demand 5 to 7 years out. When you follow this thesis in resources, you need to understand that the thesis will be delayed if there's a recession. And I think a recession is more likely than not to occur. I'm no economist, but I temper my own optimism with resources with the sense that it's likely that we're going to have a recession. That being said, in a society like ours that is as underinvested in natural resources as ours is, I think it's a mistake to have less than 20% of your portfolio in natural resources. I think it's a mistake too, unless you do a lot of work, to have more than 35 or 40% of your portfolio in natural resources. And I think for most of your listeners, the resource stocks that interest them are sub-billion market cap, alpha-oriented investments, where most of their money should be invested in much larger, beta-oriented investments that pay them a dividend, so that if the capital appreciation takes place 5 years from now rather than 2 years from now, that their investment will have paid them rent in the interim. That was very disappointing. I really, well, I had a lot of money invested in Silvercrest. Let's get that one out of the way. The report was distressing for two reasons. The plant is working well, but the continuity of the deposit underground is not as good as we had hoped. And importantly, the recoverable reserves and resources are much less than we had anticipated. There is a lot of room left in the deposit for exploration, but the comfort I had with the deposit 6 months ago, the anticipation that I had for reserve reconciliation is much lower. Well, the price has fallen so much that it's only gone from 4 to 5.
Okay.
The net present value of the deposit at strip is about $700 million. And the enterprise value of the deposit, adding market capitalization with net debt, which is fairly small, is $620 million. So in effect, it's fairly priced, and I'm getting the upside in the silver price and any exploration upside for free. It's also true that if I get any exploration upside, that it's not unlikely that an acquirer will buy the company if the share price doesn't go up, because the acquirer won't be priced in the market at net present value, but rather at a cash flow multiple. In the odd calculus of public company mining math, if a premium priced company buys a lower priced company, even in a way that isn't book accretive, it becomes accretive on an earnings basis. So you do have that, but this isn't one for the faint of heart now. Aya Gold and Silver is expensive on an earnings basis. They are not expensive on a reserve and resource basis. They are run by a very, very, very good guy. It's no longer cheap. Aya, you could argue, going back to the time of our Silver Investors Bootcamp, was cheap, but it's almost doubled in price.
Yeah.
So it's no longer cheap. Are you willing to pay up for a great asset with great people? That's the question.
Thank you for joining us in this enlightening discussion with Rick Rule. Don't miss out on the latest updates in the world of finance and commodities. Be sure to like, subscribe, and hit the notification bell to stay informed about our future interviews and discussions. Until next time, stay curious and keep exploring the dynamic landscape of global markets.